Okay, so welcome back to the fourth subchapter of the Profit Monk Newsletters Learning Center. Today, in this segment, we are going to talk about profit and loss graphs, and we are going to continue to focus on buying options, not selling, only buying. The profit and loss graphs are an easy way to understand the possibilities and risks of a trade. So let's get down to business. First, let's try and focus on the call options. So a call option contract gives you as a buyer right to buy 100 shares at the strike price before the date of expiry. So this is what you get. So let's say if you are a call option buyer, you have a feeling that this stock can potentially go up in time, then you buy a call contract and that gives you this right. Let's look at it with a simple example. So we will focus on Apple again, and let's say it's the month of June. Apple is trading at $200, and you think that over next 6 months there is a very good chance that it might go up. So what do? You buy the call contract for Apple for December expiry at $200 strike price. So you do that because you feel that Apple is going to go above 200 before December. And what do you have to pay for that? You pay, let's say for this example, a $5 premium. Now remember the previous lesson. Every contract is for 100 stocks. What that means is that the premium that you would have paid is $500. This is the premium for one stock. And for argument's sake, let's say you wait till the date of expiry to learn the fate of this trade. Now, this is how it's going to play. So let's look at this diagram for a minute. This axis here in this direction is profit and loss. So anything above this particular line is profit, anything below this particular line is loss. On the other hand, this line here, this direction, is how the stock price is moving. So this profit and loss graph is nothing but a graph between the money you make or lose and its relationship to the stock price. So let's see what happens. If the stock price on the date of expiry is exactly $200 or less than $200, you lose the premium that you have paid. So your losses are limited to $500. It doesn't matter whether the stock is $190 or $180 or $170 or $100 or $0. For argument's sake, you will lose a fixed amount, and that amount will be equal to the premium that you have paid at the start of the contract. This is also clear in the table. So if you look at the table here, you see if the stock price on the expiry date is $150, you lose $500. If the stock price is $190, you still lose $500. So anytime the stock price ends up less than $200, and because that was your strike here, you lose $500. Now what happens if the stock closes above $200? That's also quite simple. Since the premium you paid is $5, anytime the stock closes above 205, you make a profit. So that is this region in the graph. you make a profit if stock closes above $205, and that's very clear here as well. So if it closes exactly at 205 on the day of expiry, which is going to be third Friday of December, you do not make any money. You do not lose any money either. But if it closes at, let's say, $220, then you make $1,500. Why is that? This is because you have the right to buy the stock at $200. You will sell it at $220, which means you have made $20 per stock, which is $2,000 per contract, but out of that you had already paid $500 as the premium. So in effect you make $1,500. So hopefully this explanation is clear for you to understand the basics of call options.